Good afternoon, everyone. Welcome to the NZX webinar with Greg Smith from Frat Profits. Look, I know you're all veterans now on using the webinar system, but if you do want to ask a question, you can do so in the little question mark button with a bubble, and that will come through and I'll ask Greg the question at the end. If you are having trouble with audio, do have a really good look at your volume and things like that, or flick me a note. Everyone is muted, but that doesn't impact you hearing things. So if there is an audio issue at your end, even consider jumping on your phone, because we found some of the mobile phones work well. I'm very honoured to bring Greg to the group today. He is somebody that I'm a big fan of, and has been up since 5 o'clock this morning talking to Mike Hoskins about shares and things. So I will pass over to him.
Thanks, Julia. Hi, everyone. Thanks for tuning in. Hope you're coping well with the lockdown. I suppose not long to go now till we get a little bit of relief, but there is some light at the end of the tunnel. So, look, we're going to mainly talk through today about obviously the equity market impact of what we're going through, what's obviously been happening in a nutshell, what the outlook is, and where we're positioning our sort of portfolios as well, and what we're telling our clients, and yeah, just trying to give a bit of a big picture view and a bit of detail from an equity market perspective. So yeah, do ask those questions as we go along. Julia will be fielding those and passing those on, and then we'll have a little bit of Q&A at the end as well. So without further ado, just the usual disclaimer, not a particularly long one, but basically this is a general information webinar only, so not too onerous there. As Julie mentioned, if you're having problems hearing the presentation, we'll address that, but also if you've got any questions, as you can see there, you just enter it in that box and fire them away. You are muted as well. So that's that taken care of. If you can't hear me, if you can't hear Julia, don't be too alarmed. We are here, and just maybe try adjusting your volume, check your speakers are plugged in, all that sort of good IT stuff. Check your sound settings and your headphones. Okay, so what's been happening? Obviously, we know pretty much what's been happening. Most people are probably tuning into the daily updates at 1 o'clock in government, and obviously it's all over the news and the paper. So we know why we're here today in terms of the pandemic, which obviously started late last year in China effectively, but then really it's taken a grip on the world over the last 4 to 6 weeks. So won't obviously go into that. Everyone will probably know most of the statistics and where we're at. Obviously, New Zealand's done a great job of addressing it in terms of the infection and fatality rates, but obviously there's quite a bit of economic fallout on the other side, so it's a bit of a balancing act, isn't it? But look, let's start, as always, we are in an increasingly global environment, aren't we? So as we know, the US indices tend to get a lot of attention in terms of leading the rest of the world, and also apt at the moment because the US is effectively the epicenter of the COVID-19 crisis. So and one of the world's largest economies, not the fastest growing, but obviously there is the largest. So if you look at the S&P 500, which is the top 500 largest companies in the US, you can see there that, and you probably are also aware that we've had quite a significant bounce in the market since I suppose all the pain and fear was circulating. And where are we? We're basically back to where the S&P 500 was a year ago, which I suppose is not too bad considering we've had not only obviously the coronavirus once in a 100-year event, but also obviously the trade war last year as well. So as you can see there, it's really quite strongly in line with a lot of other markets. It's up about 20% since the lows of March 23rd, back to where we were a year ago, around about 17% from those February highs. So look, it's been an interesting dynamic, I think, watching this, commentating on this, investing on the back of this over the past 4 to 6 weeks. Initially on those lows, it was peak fear, it was panic. It was, this was just the worst thing ever. It was the end of humanity type thing, Armageddon scenario, wasn't it? So that, was probably for the market around about those lows. And then we've continued to have obviously fairly bad headlines about fatality rates and economic damage and so on. But the markets, tend to react ahead of time. And as you can see there, the S&P 500 has been climbing upwards. A lot of that is to do, I think, is about the market looking through to the other side of those peak infection rates and indeed fatalities, and what the bridge is like effectively. Now, the bridge to the other side, from a financial perspective, is obviously being created by governments, by central banks, and just trying to get the economy and trying to get as many businesses as possible through the other side. So I think now, we've seen the markets recover, watching those daily stats that we're getting. Just wondering now, we're seeing more of the economic fallout being put in front of us. So it's almost like all the infection and fatality rates have gone to the side a little bit. So that's what I'm going to talk about a little bit today, and what that means for the markets and also some sectors and companies in particular. Now, we just go on, and just this index might not be that well known to many out there, but the reason I put it in, it's called the VIX Volatility Index, and it's actually from a market or an equity market perspective, the level of fear that's running out there. And backdated this to the GFC back in obviously 2008. You can just see there that the markets have been really fearful of what we've seen. Got up to levels around about what we saw during the GFC, but I think marked similarities, but also marked differences. Obviously, we've gone through a shock. It's been more, I suppose, a one-off shock. We would hope. Whereas the GFC, the headlines back then were about companies going under every other day, but it was also about whether the financial system was going to be around next week, next month. So I think this is more an economic shock that we're witnessing, which is why, even though it's terrible on a number of levels, you've seen the volatility index or the VIX index come back from those peaks, got to around about over 80, as you can see there. It's pulled back lately. And this also sort of reflects the fact that equity markets seem to be settling down a bit. And by that, I mean, a few weeks ago, we'd potentially wake up in the morning, you'd see the US markets down 8, 9, 10% in one session, just unprecedented. Whereas now those trading ranges are narrowing. So despite what we're hearing and seeing and obviously reading about COVID-19, the reality is, from an equity market perspective, the fear is dissipating a bit. It's still elevated, and we're certainly not through we're still not out of the woods yet, but certainly it's coming back, and that has to be a good thing. And we are seeing moves to the downside in many indices in recent times, but it might be 2% or 3%. Same on the upside. So just a bit more stability coming in, which I think is what we want to see as an investor. Now, we're mainly going to talk about New Zealand today, but in the Kiwi market, but we'll address it from a global perspective as well. But you can see the NZ50 there, similar sort of shape there actually. You can see we've had that big decline on the red side of things, and then a big move up on the green arrow. So NZ50, that's rallied about 18% from the March 23 lows, fell around 30% peak to trough. It's still around about 14% from those highs which you're seeing back in February. And I think that's pretty fair. I don't think anyone could say or justify the equity indices going back to where they were in a hurry a few months ago. I mean, this is not going to go away in a hurry. There's lots of financial medicine being administered, but lots of areas of the market, are going to change, and perhaps for a long time. So I think it's fair enough. We're effectively seeing a V shape in the market. And I think that also is reasonable in line with what we expect in the economy. So I think we see that. I think we get a V shape. I mean, obviously there's lots of debate over whether it's a V or a W or all sorts of letters of the alphabet. But I think we can see a V shape. We've got plenty of stimulus coming through, government, central banks. But as always, there'll be nothing goes up or down in a straight line. So I think NZ50. The other point about both these indices, the S&P and the NZ50, is they're actually getting back up towards their earnings multiple valuations. So if you look at it on a price over earnings basis, we're about 19, 20 times now for both indices. But obviously the outlook for earnings has fallen. So that's probably just something to be aware of. Okay, so why might we be positive and investing in Kiwi stocks, Kiwi market? not not sort of abandoning our share portfolio. Well, yeah, again, an obvious one. We've had pretty much the most restrictive policies in the world in terms of containment, shutting the borders. That was a great move. Should have probably happened earlier. And we're effectively seeing it eliminated. And I think look, we don't want to get too hung up on the amount of people. I know it's terrible to see here that 1 or 2 or 5 people died from COVID-19, but yeah, we do need to put it in perspective. And you can imagine if we had daily stats on how many people died from typical influenza. You can imagine it'd be equally appalling. And in fact, it was only last winter that I think it was 15 people died in an Invercargill rest home in the space of 2 weeks. And that didn't even make the news. Whereas obviously now we're seeing these pretty horrible statistics. But the reality is we have kicked COVID-19 into touch. Now there's also always that reinfection risk. No one knows that. Even the smartest epidemiologists in the world don't know that. So I won't pretend to know that. But you have to look to China, which is 2 months ahead of us on terms of the infection and what they're seeing, and also their economies now open, fully open pretty much. Then that I think is a good guide. So look, no one can be completely certain of how this plays out until we have a vaccine. No one knows when that's coming either. But in reality, it looks like on balance we're rid of this thing. And as long as the borders remain closed, you'd have to think there's a reasonable basis for believing that will remain so. Look, another reason to be positive. China, I mentioned them. They're back on their feet. Their factories are back humming. They're in a lockdown effectively for 2 months. They're our biggest customer. You can't really sort of talk about New Zealand or indeed Australia or many countries without looking at the economic well-being of China. Their quarterly figures have been terrible, but they wouldn't be effectively shut down for 2 months. So they're getting back. And like many countries, they've got a massive stimulus plan going. So rebuilding, getting the economy back on its footing. So they may well decline double digits on an annual basis, but they'll probably bounce back that and then some. So I think that's encouraging for New Zealand. Also, obviously, the cost of borrowing hasn't been so cheap either. The RBNZ arguably went a little bit early on some of those, on that 50 basis points earlier in the year. But same, albeit obviously rates are very low. So that's again, it'd be a situation to be in than if we had a higher cost of borrowing. And obviously, of course, there's bond buying going on as well to stimulate the economy. Obviously, we've got the LVR measures which have come out as well to support the housing market. Currency as well is another big one. Shock absorber, for us, that's, and for indeed many nations, have had very much a bit of a race to the bottom in recent years, and indeed since the financial crisis, most countries have been effectively engineering their currencies lower to be more competitive, and we're certainly not alone there. So I think the point has been made as well with the Kiwi dollar. Where exports are a big part of our makeup. So I think the Kiwi dollar around sort of 55 to 65 cents even if we saw a bit of a climb upwards. It's going to put our economy and ultimately our companies and exporters and the trickle down wealth effect in a reasonable position. So continue to see that as a strong shock absorber. But look, there's going to be some pain ahead. That's for sure. So obviously, 2 of the big companies in the news and companies that a lot of people would own are Air New Zealand on the left here and Auckland Airport on the right. So understandably, we've seen a move from $3 in Air New Zealand down below $1. I mean, we had the banks in the GFC. And effectively, we're looking at the airlines in the current crisis, aren't we? And sort of tourism generally. So this is the issue for New Zealand. I mean, the industry has changed, I think, for a while yet. So look, there's been a bit of optimistic buying in New Zealand of late. To be honest, we're not completely convinced by that, and I think it says a lot when you look at Auckland Airport. They've raised money. A lot of money to get them through till December 2021. So not the end of this year, end of next year. That's how long they think the headwinds could be going on for, excuse the pun. So I think that's they are effectively covered in terms of their situation. But then you look at Air New Zealand, they've got obviously some assistance from the government, but that's only for an interim period. So I think I was talking about on the radio this morning, actually, I think they had 175 people in total flew on Air New Zealand planes yesterday. So they're basically stopped. International travel is dead. And the only way that's really coming back is in two ways. Either we get a vaccine and COVID-19 is completely gone from the planet, or we perhaps get instant testing, and that those will remember the security checks after September 11. I mean, that won't even be a touch on what we'll be seeing if everyone has to go through an instant coronavirus test when boarding a plane. So that will just be monumental. So even if we got that, that's certainly going to slow down things. And I think the other point as well is that even when planes do get back in the air, everyone's aware of social distancing and the restrictions will probably continue. The likes of Air New Zealand will probably be flying their planes half full, and it's pretty hard to make money on that. So, not beating down too much, obviously recalibrated. They're effectively going to be a domestic airline for a while. I mean, maybe we open up with Australia, but that's not for certain. So just very aware of that, and also the fact that obviously the government has that debt stake. There is obviously a risk if that gets added to, then effectively they convert that to equity, and a lot of shareholders get diluted. So look, I think Air New Zealand's in a lot better shape than many other airlines. The industry's also been getting bailed out left, right, and centre. Virgin Australia has effectively gone to administration, so that's a net positive, I suppose, for Air New Zealand in terms of less competition. Virgin Australia will be very much a smaller airline, but we'll just be a little bit wary of going to either these stocks. Certainly on a trade, I think if you take a sort of a 3 to 5 year long-term view on both of these, then that's probably at a minimum. So I think just be cognizant of that when looking at these two big travel stocks. Now on the other areas, I suppose I'm addressing sort of the areas we're not so keen on first. So don't get too despondent saying that and thinking we're all negative. It's certainly not that. But retail spending, I think again is going to be a bit challenged. I've seen a lot of broken notes lately. Positive. I saw one right this morning on Sky City and talking up the recovery prospects there. Just not so sure about that. Obviously the borders are closed, so that's going to cut off a lot of the VIP traffic. And then, the scenario where people are bursting through the gates to, have a flutter on the roulette table. I'm just not so sure about that. I think the consumer is going to be challenged for a while. So I just don't really see that. So again, just be a little bit wary of that. And obviously, it's had a good rise since the lows there. Warehouse probably a bit more defensive. Obviously just with their price points. So possibly there's some merit in that. But that said, the high was 280, you're at sort of 220 now. There's probably better opportunities around. But they will be back in full swing when we get to level 2. So I suppose that is at least something. There might be a bit of pent-up demand there. They're doing a bit of online loan, but just to be a little bit careful about the retail sector. And you can see there on the left-hand side, just from Stats New Zealand, just what's been happening in the various segments of retail, and obviously hand sanitizer and toilet rolls have been literally flying out the aisles, but obviously many other areas under pressure, and obviously including fuel, and obviously hospitality, which has fallen off a cliff. So look, they're probably the two areas we are the most wary of, tourism and the retail, and we just think they're effectively in the eye of the storm, and that storm for these sectors might continue a little bit longer than some people seem to be thinking. Then there's the property market. Now this is an interesting one. Obviously, this is Ryman's. This is our largest by cap retirement care village. On the right, there's a share price here. So it had a pretty monumental rebound. Got from below $7 up to 12. Pretty impressive. So look, obviously we've protected the retirement sector there. Throughout this crisis, they've been obviously a key beneficiary. Unfortunately, obviously the deaths have occurred largely in this space as well. But look, it's a stepping back from all that, very defensive sector, and I think the underlying demand there is going to be obviously strong for some time. We've got an aging population. Can Ryman get back to $15, $16? Quite possibly. But the reason also I've got this house price and sales data as well on the left-hand side, and no one really knows how the property market is going to play out, is that the retirement care operators have over the past 5, 6, 7 years had a big earnings kick from upward property revaluations. And you think of people that sort of can't wait for the Auckland Council valuations on their home and look at how much more their home's worth. That sort of revaluation kicks on through to the bottom line, the retirement care operators. So, what's the property market going to do over the next sort of six months or so? I doubt very much. It's sort of going to be back to the races again. I think obviously we've got low lending rates. Those LVRs are going. They've been in since 2013. Foreign buying's probably dried up. So it's going to be an interesting one. Then again, New Zealand might be seen as a bit of a bolt hole, given how well we've got through the crisis. So I think it's just a factor to bear in mind. It might just prove a little bit of a stiff headwind, but I think there's no reason why Ryman can't go a bit higher yet. But the property sector is going to be very interesting over the next few months for sure. And I think there'll be plenty of buyers probably still sitting on the sidelines, see how it unfolds in the coming weeks. And obviously potentially we've got we should have an election at some point later in the year as well, which the property market typically does react to. Now, what do we like? What sorts of companies can continue to do well? Well, certainly Fisher and Paykel. Healthcare has been obviously thrust into the limelight during the crisis, but Fisher and Paykel's done well for some time. The fact that they make ventilators, is only part of it, and that's gained a little bit of attention. But a great business, got great offshore earnings. Yes, it's been repriced quite significantly upwards, but then again, it's well placed, and that currency plays a part as well. Then, I think it's still a very solid component of anyone's portfolio. A2 Milk, similar sort of story, should I say. Again, all the concerns over wellness are certainly playing their part. I mean, while the crisis has been on, A2 Milk has actually risen around about 33% during the COVID-19 pandemic, or the amount of time we've been concerned about it. So look, infant milk in Australia is literally flying out the aisles as well. It's doing very well in China. That's a key market for them. As mentioned, China's back on song in terms of its economy, and it just seems to be going from strength to strength. And this is a very curious stock. Many of the brokers were quite negative on it, around about $2, and I know plenty of people that were in the stock a lot lower. But it just continues to push high, and I think it has every reason to. Very well managed. They had a reasonable update this week as well, I thought. Look, it might not see the same momentum over the next 6 months that it has over the last 6, but I think it's still a reasonable global leader in terms of a local stock. Spark, New Zealand. The telco is obviously very defensive. They see plenty of buying, I suppose, in times of financial stress. And I think Spark's held up very well. You can see there, it got down to the lows, and I think the rally in this stock is actually now completely justified. We had a few reservations about Simon Mutter going, but he's doing a very good job. Their update yesterday, and obviously a lot of investors, particularly those that are looking for dividend yield, are concerned about whether dividends can be maintained in this environment, and that's a very significant point. Well, Spark came out yesterday pretty much reassured over that, and also earnings projections. So look, whilst none of us are moving around the country and roaming or going overseas, and their roaming revenues are taking a bit of a hit, and obviously they've also, like many telcos globally, have put data caps to placate the general populace. But we're spending a lot more time on the phone. It's not just about Zoom. Phone calls are going up, obviously, as everyone's pretty much hunkered back in lockdown, and also data as well. So I think the big thing on the horizon for Spark, once we get through all this, and I think you have to look what's on the other side. And the driver here, I think, continues to be 5G, and this company's seen a great transformation A little bit further down the scales is restaurant brands on the right. Now, the reason I continue to like this stock, being a KFC, Taco Bell, and also Pizza Hut operator, is just the defensive nature of it. Now, it's had a little bit of unlike a lot of other countries around the world, New Zealand has not allowed takeaway food. So I'm looking forward to that next week. But that will end next week. So it'll be back to normal service almost. And I think there'll be certainly a pent-up demand there. But not just looking about the next few weeks, but we are taking a bigger view. But the reality is, in many countries, once sort of lockdown measures have been lifted, the takeaway food operators have been struggling to keep up. And people are also a little bit conscious about going out to restaurants and social distancing. So yeah, these areas have tended to surge, and Restaurant Brands earns most of its revenues through delivery and takeaway. So I like this. I think the other interesting, a big picture point on a lot of these types of businesses as well. I do think we're going to see severe pressure on rents, not just in New Zealand but globally over the next few years. And not saying we're going to get massive amounts of businesses go under, but I just think there's going to be that cyclical pressure coming through, and particularly a lot of traditional retailers. When you think about the high street, if you want to call it that, maybe either downsizing or retrenching a bit. And I think that'll be great news for companies like Restaurant Brands, which are looking to expand their footprint. They might find they may be able to do so at a much cheaper rate. So a couple of companies we like there. Can't really have a webinar this week without talking about oil prices. It was pretty incredible getting up a couple of days ago and talking about the oil price at sort of 6:15 in the morning on the radio, and watching it go from 90 cents to negative $40 on the May futures. So I'm sure some of you may have actually heard on the news about what's effectively happened, but this was the May futures contract for oil, and effectively demand is collapsed. It's down 30%. Supply hasn't been reduced enough, so the world's awash with oil, and this crude contract rests with physical delivery as well. And there's just literally not enough. There's not enough storage to cope with all the world that sort of has been swashing around. So literally, people have been paid, investors or traders should I say, paid counterparties to literally take the contract off their hands. So, but Brent, even if you look at Brent oil, which is a slightly different contract, oil prices, as we know, have fallen significantly. So that's why that's good in a way, because the oil price is a tax on the economy. The oil is used in a host of manufacturing processes. It's not just about what the petrol we put in our car or the fuel that goes into jet airplanes. So I think, in this point of view, we've got two stocks here, sort of want to draw some attention to. So we've got Meridian, which is the gentailer. And I think, look, for this, it's probably a net positive. The New Zealand economy, keeps going, as I've talked about. Demand, quite defensive demand's going to be there. The only thing probably hanging over a lot of companies in the sector is Tiwai Point, which around about 20% of the country's demand. So if Rio Tinto, which it often does, reviews whether that smelter is going to be closed or not, which would be devastating, then that's probably the main thing hanging over. I don't think they'll do that on balance, and we've seen aluminium prices actually tick up a bit in the last sort of few weeks. So I think overall Meridian's looking like a pretty good play, and lower oil prices will effectively help increase margins for a lot of businesses, including Rio. And then we have Z Energy, and that's sort of a middleman, isn't it? And so driving past the forecourt, I see petrol's gone under $2, but obviously that's not a lot of use to anyone. But their big thing as well is they have a 15% stake in Marsden Point, or New Zealand Refining, should I say, which owns Marsden Point. So that's certainly fallen away in terms of demand, and so much so that New Zealand Refining is actually talking about separating its infrastructure assets and becoming a net importer of fuel. That's probably a topic for another webinar, whether New Zealand, and I know Australia is talking about this, should actually be using the decline in the oil price to boost our energy reserves. But that's probably a topic for another day. I hope this has been useful. We're going to mainly, I find it's always best to hand over to sort of Q&A, which we'll do shortly with Julia. But just, the key thing here is what I'm saying. I think on balance, you need to be mindful of obviously the risks that there are in terms of what we've faced and are facing. But then on the other side, what the reasons to be positive. And we've seen an unprecedented crisis in some ways, but then again, it's not. And we've seen an unprecedented response by governments. We've seen, I think, given the US Senate has just approved a cheeky half a trillion in new funding, that takes the total stimulus packages or rescue packages by governments to over $3 trillion. So that, that's if New Zealand had done nothing, or the world, or Australia or the world had done nothing, we would be probably looking at 30% unemployment. But we've seen these stimulus packages. So again, from a market point of view, it's just working. And history is always a great teacher. If you look back at, and this is the Dow Jones rather than the NZ50, I'll get to that in a minute. But if you look at the 1930s to 1945s, after the Great Depression, the Dow Jones, top 30 companies in the States, great rally. You can see there from the lows, and that was notwithstanding a world war. 61 to 63, why is that relevant? Cuban Missile Crisis. World was on the brink of nuclear war. Again, massive rally. Dow Jones 72 to 76 at the bottom there. After the oil price crisis, when prices were actually too high rather than too low. Again, big rally in the markets in the ensuing months and indeed years. So I think just be mindful. History does repeat, and obviously there's a lot of despair out there, but the market will also tend to react ahead of time. And then just closing with the NZ50 chart again. We're still a wee bit from the highs that we saw earlier in the year, but there's been a nice uptrend there. And again, you can see that little orange circle to the left there, the global financial crisis, massive amount of money printing and stimulus, and that pretty much laid the course for a 10-year bull market. Now, what we're seeing now is actually dwarfed what was dished out during the GFC. So, history may even repeat. I think, one outcome of this that we're going to see, and which is ironic given weak CPI figures this week, except with the exception of, I suppose, the supermarket goods and the like, is that we're going to see inflation, I think, over the next 2, 3, 4 years accelerate significantly, because a lot of the money that's being dished out, a lot of it's going to be printed. So it's just going to debase fiat paper or currency, and that drives inflation. So look, I think New Zealand's reasonably well placed in that event. We've had a very strong economy for some time. There's plenty of shock absorbers there, as I said. But I think it does, pay to be selective about which stocks and sectors you get into. And I think they're just about my half an hour on the dot, not too far off anyway. So look, I'll hand it over to Julia for a bit of Q&A.
Right, so we've got a couple of questions here, Greg. So the first one is in regards to consolidation of industries. So some industry consolidations are likely to occur out of this. Any picks on which large industries will see this internationally?
Yeah, I think there could be the obvious ones, I suppose, would be those that are the most under pressure, and consolidation can occur for a couple of reasons. One, to pursue more growth, and that can be sort of at the top of the cycle when you think of mega mergers and the like, or the other can be to literally survive and extract synergies, reduce cost bases, and so on. So look, I think the fairly obvious one is tourism and travel. Some companies might not make it and will be swallowed up. A good example is Virgin in Australia. They've gone to administration this week. The state governments are sort of fighting over the rump there. They'll probably continue in some fashion. They're probably not going to be bought by Qantas, but they could even be bought out by one of their shareholders offshore. So, but I think the airline industry anyway it's been a massive wake-up call. It probably was suffering from overcapacity anyway, and this is just going to reinforce that. So there will be failures, there will be combinations. I think also on the tourism side as well, we may see this domestically, and we may see this internationally in terms of even outside outside that sphere. I'm not so sure about the cruise line industry. Obviously, that's had a pretty bad rap over the last sort of few weeks, and disease incubators. Although I was actually reading that well, I think it's more than half people that had their cruises cancelled this year have actually signed up for next year, which is pretty amazing. But I think that that will struggle. Although that said, the point in all this is that obviously an alternative to combinations is raising capital. And most of the companies that we've seen raise capital in the last few weeks have had a lot of success. I mean, admittedly, it's been at steep discounts in some cases, but it's actually been relatively finely priced in others. So, the world still, despite this massive shock it has, still has plenty of liquidity, both the corporate sector and also sort of on the sidelines, investing wise. So I think that may help. But look, I think certainly there's going to be some consolidation in those sectors the worst hit, and it'll be some companies will see it as an opportunity to pick up distressed assets.
Awesome. We're going to move on to interest rates. So the question is, interest rate swap curves look flat with a range from 1 to 5 years, 35 points. Why are bank lending rates ranging from plus 135 points between 1 to 5 years?
Yeah, well, I've got a couple of colleagues involved in the banking finance sector, and I've actually spoken to them recently. But obviously this is to do with the wholesale funding, the wholesale rate. That's what you really need to look at, and it's basically the risk premium that's being priced in. I mean, and that's understandable. Literally, as I've just sort of said, a lot of companies, a lot of individuals, and in fact, I won't say the majority, but a lot have got their hands out, and obviously there's only so much funding to sort of go around, and that's times when like in any economic situation where a premium tends to get priced in. So I mean on that point, I think the interest rate curve generally though will, and obviously there's been a lot of talk about this before COVID-19, which is it's basically become inverted, and it was interest rates at the short end have obviously been heading down as well. But I think I see interest rates picking back up, and that goes with our view on inflation. So, it won't happen. I'm not saying it's going to lock in your mortgages this year or anything like that, but I think, over time, as we get that inflation coming through, it'll tick back up. And that goes with our view as well, that why I think the equity market, I think it's arguably still in a bull phase. Might be hard to sort of comprehend that given what we've been through, but you've seen the fact that goes to that is the inclination of investors to sort of buy that massive dip, but also the liquidity we've got. On the other hand, I think the bond market's going to have a rough time. Pretty much in a bull market with 3 or 4 decades. I think the bond market is going to see a lot of pressure over the next 3 to 5 years.
Awesome, thank you. We've got a few more here, quite a few more. Given the markets are forward-looking and the economic outlook for the next 12 months surely looks tougher than it did 12 months ago, any particular reason why we think the market is at the same level as 12 months ago?
Okay, so the S&P 500 is actually at the same level it was 12 months ago. So the index, and that's actually a fact. So if you looked at it, and that was my point on my first slide. So if you're buying the S&P 500 index today, you'd pay the same as what you did a year ago. So that's pretty amazing. I completely agree with that. That doesn't really seem to make much sense in many ways. So again, it's saying being a little bit wary, and we're going through the corporate earnings season at the moment in America. It's got around about 20-30% of the industry companies are due to report this week. So I think that presents potentially a downside risk. As I was talking about, I think the first phase of that bounce has been about investors looking through the COVID pandemic and thinking, well, this is not Armageddon. It's bad, but it's not Armageddon. But I think the next phase is that the economic data and potentially the corporate data that comes through is maybe going to hit home, and that's why we think potentially the next few weeks could well be a bit rough. We've had a big run. I don't think we'll take out those lows that we saw a few weeks ago, but I think the NZ50 and many equity markets could certainly start repricing the reality that the economy is in a is not in as good a place as it was a few months ago. But that said, that's the reasons to be positive further out, still there. The amount of stimulus coming through, trillions of dollars, all the various supports we've got. So I agree. Come the end of the year, the New Zealand economy will certainly not be in a better position than it was a year ago. I mean, it'll be in a better position than it was coming out of the GFC for sure. But I think that's why a bit of caution is probably due.
Awesome. We've got another one here. It's just asking for you to comment on the commodity outlooks, particularly reliance on the iron ore price.
Yeah, I mean, iron ore is a bit of a pet topic of ours, actually, so it's almost like a planned question, but which is not, of course. But so iron ore is an interesting one. So used in steel making, one of the biggest customers is China. So I was talked about China's getting back on its feet, so that's great news for them. But if you look at the iron ore price, it's hardly flinched. It's been around about sort of 80 to 90 US dollars a ton pretty much throughout the crisis, and didn't even really flinch much last year as well during the trade war. And why is this? Is because iron ore, steel, China's building, China's rolling out infrastructure, and it's being lapped up. We don't really have any iron ore producers here, but Rio Tinto, they came up with an update the other day. BHP, their iron ore production guidance, they're sticking to the same guidance for this year, so it hasn't really affected them. So which I think is pretty interesting. The other point, I think commodities generally will catch a bit of a tailwind if volumes are going to remain pretty strong. They will actually catch a tailwind if this inflation comes through, and that drives commodity prices. Other commodities, I might just mention those quickly, but other commodities have been under a little bit of pressure during the crisis, but have also started to recover. I mentioned aluminium, things like zinc are sort of picking up. Most things, in fact, oil really has been the odd man out. I mean, it's been a pretty big odd man, but it's certainly been the odd one out. And maybe I'll just mention gold as well. I think gold's more a currency rather than a commodity. That added around about $50 last night. And I think we'll probably take out the highs on gold, which was seen in around about 2000 and just leading into the GFC of around about $1,900 US dollars an ounce. I think we go above that by the end of the year. I think we hit 2,500 next year. We don't have many too much gold exposure on the NZX, but certainly there's a bunch of it not too far away listed on obviously offshore. But there's obviously ways to play that as well through ETFs and the like, I suppose, is one way to do that. So I think the gold's worth keeping an eye on. It's seen a bit of a bid now because of the safe haven appeal, but I think the biggest story is when we get inflation, where that goes from here. So but iron ore looking good, and I think base metals producers are probably looking quite interesting now too.
Awesome. Now this one's about the printing of money. So over the last 10 years, printing of money hasn't resulted in inflation. Why do we think it will this time?
That's I think it's just because it's really on a unprecedented scale. You're quite right. It hasn't seen inflation as such. It has certainly seen the worries about inflation priced in, and I'll come back to inflation in a minute. But if you look at the gold price, it was $250 an ounce before a little thing called the .com crash. Alan Greenspan came along, stimulus ensued, low interest rates, and the gold price went to 1,900. Then it went back, and then it rose again out of the GFC. Again, more stimulus, and again we're seeing a move this time. So I think, we haven't had it. So is this time going to be different? I mean, that's probably the question. And as I said, the main thing is I think it's been a bit more unprecedented. We saw a certain amount of money printing out of the GFC, but New Zealand never engaged in quantitative easing. Australia never engaged in quantitative easing, and both those central banks are now doing that. And the amount of stimulus literally being in fact, it is almost being dropped out of not quite dropped out of helicopters, but Donald Trump sending checks in the mail. Then that will have to sort of, you would think, come through to inflation. The trillions of dollars is happening. And that's also on the basis that, obviously we get the economy rebooting as well. Obviously the GFC took quite a while. Many economies may just really recovered from the GFC when you look at the likes of Europe. So I think it will be a little bit different in that regard this time, but that's a good point. And we have been used to low inflation for obviously some time now, several decades, as we've all been used to fairly low interest rates. So what I'm saying is that there's a good prospect of that change. I don't think we're and it gets dangerous when you talk of new paradigms. I've heard that before, and people say, oh, well, it's inflation's never going back up and interest rates are never going back up. A lot of people think that until it actually happens. So, I think just the scale of it this time around and the various measures, being adopted.
Nice. So we've got a couple of toughies here. Given the demand implications of COVID-19 and the increase of forward PE ratios back to historic high levels, do you have a view on where PE ratios should be?
So as mentioned, the S&P and the NZX are about 19, 20 times now. So they got down to sort of 15, 16 times, and they've been as high as sort of, the S&P's certainly been 23, 24 times. Where should it be now? Feels like it should be a bit lower. Obviously and this is when we talk about forward PEs. The forward PEs are only as good as the best estimates of the consensus that's producing those earnings forecasts. So if that all makes sense. So I think the reality is that investors are being paid quite a bit still to compensate them for risk. When you look at investing in equities versus alternatives, investing in a bond market, in some cases where you actually get less back than what you paid when you look at negative pricing in, say, Europe and so on, and the cash rate, which is pretty much next to nothing. So there's a certain amount of compensation there. So I think that's why we can probably see investors being prepared to pay more than the historic norm in terms of PEs. So north of 13, 14, 15 times. But I agree. Over 20 times, as history has shown, it's never that sustainable for too long. So. I think it's certainly worth keeping an eye on, but also this is also about why we're perhaps not looking to so much invest in the market as such, but be a bit more selective, because there's still some companies out there, and some which I've discussed today, which relative to the market are on pretty undemanding multiples.
Cool. And I'll just ask a couple more because there are a few, but I don't want to keep you all day. Any thoughts on financial or banking stocks given an amount of QE?
The banks are obviously an interesting one, aren't they? And very important. We have a lot of clients in Australia, and the banks are hugely important to many investors there, just because they rely on them for dividends. So obviously in New Zealand, we have or the powers that be have effectively stopped the New Zealand subsidiaries from paying dividends. In Australia, they're a bit more sacrosanct. So look, I think the funniest thing about, if we can use that word, about the banking sector at the moment is that they got an absolute pasting, during the Royal Commissions here and on the other side of the Tasman even more so. And they've now, sort of being, I know Jacinda Ardern mentioned this, Scott Robertson, Scott Morrison came out yesterday and said that the banks were part of Team Australia. I just find that completely ironic, given even the RBA governor as well was also sort of talking them down, talking them up, should I say, given they were seen as the villains only 2 years ago. Anyway, so banking stocks have copped it, for a few years now, haven't they, on regards of that, the Royal Commission. I'm not saying that was without grounds. I think, look, if we see the economies recover, if we're a bit more positive on the economies, then I think the banking stocks do better. Most of them are trading on pretty low multiples, even if you look at the historic. So I think there will be dividend cuts, and we're talking about the Australasian banks in New Zealand. There'll probably be dividend, there are, obviously it's already been put through, but in New Zealand there will be pressure on earnings for sure. But will the extent, and obviously the banks are being asked to do a lot. Anyone that's got their hand out basically will be getting it. So to a certain extent. So the big question really investing in the banking sector is the market's best estimate of what the write-offs and losses, their impairments are they excessive? And I suppose that's the big question. Some of the anecdotes we've seen coming through is we haven't really seen that stress on the consumer or retail customers of banks just yet, but you would have to think that probably is coming. I think the gorilla in the room is what happens to the property market, and that goes for New Zealand as well. So but obviously if the banks are sort of being a bit more lenient, then that the worst case might be averted there as well. So certainly I think the banks offer a lot of value, and I think if you're going into them, you take a longer term view on the economy, getting through this all, and the write-offs not being that excessive.
Awesome. Now I'm just going to have one last question here: is why hasn't FPC recovered in line with the market generally?
That's a good point. We've got a fund, and it's a hedge fund. So a lot of the exposure there has been in China, which got hit worse, I suppose, earlier on a few months ago. So what we're finding now, actually, there's a lot of those positions are ticking up. We've run it a bit more global as well, and I think we'll start to see that coming through. So some of the cornerstone positions and that are I suppose stay-at-home stocks. I mentioned Restaurant Brands actually, and one of our bigger holdings there is Domino's, and they've been literally they've been open in Australia throughout the lockdown over there. So they've been going gangbusters. New Zealand's reopening next week, of course, as well. Japan and Europe have been going really good. We've got lots of sort of QSR or quick service restaurant stocks, but also taking a bit of a view on China. So we're starting to see the portfolio value tick up. The other important value for our fund is actually listed on the ASX, but it's an LIC and it's trading at a discount of to NAV of around about sort of 15 to 20%. So that's sort of worth bearing in mind. But talk about the sort of the COVID pack really, sort of quick service restaurant operators, stay-at-home stocks. Netflix has been hitting record highs. That was overnight actually. They delivered double the number of subscribers they were expecting. I think it was around about 15 million in the first quarter versus 7 expected. So similar situation in other streaming stocks. Obviously, we haven't quite seen that with Sky in New Zealand, but if you look across the Tasman, Nine Entertainment, they've got Stan, which is a big streaming operator over there. They'll be doing very well during the lockdown. So I hope that answers the question, but it's trading at quite a bit of a discount. But our view, and I've expressed a bit of it here today, is very much to back the recovery stocks, back companies that are going to do well through the other side, and just be selective. But regionally, we very much like China, and we're talking about multiples earlier, just before. I think China is certainly worth looking at as a market when you think that it's back on its feet, and the PE is not much more than half what you're paying for the S&P 500 or the NZ50.
Awesome. Well, look, Greg, we're going to wrap it up there. I want to thank you. This has been fantastic. For those of you still viewing and listening, Greg has been very generous, and we have recorded this, so this will be made available if you want to go through it again and just pick up on some extra tips. But have a fantastic afternoon, and thank you so much, Greg.
Yeah, thanks, Drew. Thanks everyone for tuning in. I hope you got some value out of it. Stay safe and during the lockdown, and hopefully not too much longer to go. But bye for now.
Thank you.